The exchange rate has now become a very serious issue. During the day, it broke through 1,541, and it's now at its highest level since the financial crisis. Some even say it's only a matter of time before it surpasses 1,551. Let's take a closer look at this issue today, but before we begin, if you want to get the fastest overseas news in Korea, please hit the subscribe button for Census Studio. The $1 exchange rate continued to rise right after the market opened on June 5th, surpassing 1,541. The $1 exchange rate reached 1,542 which is a very serious situation. This figure is the highest since the 1,561 recorded during the 2009 global financial crisis. It's the first time in 17 years and 3 months the exchange rate isn't going down and continues to stay above 1,501. It's been above 1,501 for 13 consecutive trading days, the longest streak since the 1997 foreign exchange crisis. Why is this so serious? The average exchange rate right after Korea received IMF bailout funds in 1998 was 1,398.881. You can probably get a sense of how serious this is. The exchange rate is so high that even foreign investors are continuously selling off domestic stocks, with net sales of 1.4 trillion just in the morning, marking the 20th consecutive trading day of net selling. Because the exchange rate is high, they can make even bigger gains. As of the time this video was made, the Kospi had dropped more than 6.5%, threatening to fall below the 8,000 mark. This is partly due to the weakness in semiconductor stocks on the New York Stock Exchange, but the exchange rate is also having an impact. The problem is that this continued net selling by foreign investors is also fueling the rise in the exchange rate. Since May 7th, there has been continuous net selling. The cumulative net sales have exceeded 66 trillion won. If you look at the whole year, the net sales are close to 120 trillion won. Many experts and financial institutions are pointing to the interest rate gap between Korea and the US as the main reason for the sharp rise in the exchange rate. Korea's base interest rate is around 2.5%, while the US base rate is 3.75%. There's a 1.25 percentage point gap between the two countries. In financial markets, interest rates are a very important factor in determining the direction of capital flows. That's right. For investors, it's more advantageous to put their money in countries that offer higher interest rates. So naturally, there's a stronger preference for dollar assets. Especially recently, with global economic uncertainty increasing, the preference for safe assets has become even stronger. With armed conflicts in the Middle East, rising international oil prices, uncertainty over US tariff policies, and concerns about a global economic slowdown all happening at once, investors are moving their money from risky assets to safe assets like the dollar and US Treasury bonds. In this environment, demand for the dollar continues to rise, while the value of the won is relatively weak. That's why the exchange rate continues to face upward pressure. In the past, when the US raised interest rates, the Bank of Korea often adjusted its interest rate policy in a similar direction to prevent capital outflows and maintain exchange rate stability. But the situation is different now. With concerns about a domestic economic slowdown and a heavy household debt burden, it's difficult for the Bank of Korea to aggressively raise interest rates in line with the US. If interest rates are raised too much, it could further dampen consumption and investment. That's why the interest rate gap between Korea and the US has persisted for a long time. What we need to pay more attention to is the duration of the interest rate inversion. In the past, there have been several instances of interest rate reversals between Korea and the US, but most of them ended within about 2 years. This time, the interest rate reversal has lasted 48 months since 2022, which is highly unusual in Korean economic history. In the market, there is more concern about the prolonged duration of this situation than the interest rate gap itself. On top of that, foreign investors are also selling domestic stocks. When foreigners sell Korean stocks, they exchange won for dollars and then remit the money overseas. This process increases the demand for dollars in the foreign exchange market. Some analysts say that foreigners' recent net selling has increased upward pressure on the exchange rate, so the financial market is closely watching the Bank of Korea's interest rate policy. If the United States maintains high interest rates for longer than expected, the interest rate gap between Korea and the US could also persist for an extended period. On the other hand, if the US cuts interest rates more quickly, or if there is a change in Korea's interest rate policy, the upward pressure on the exchange rate could be partially eased. The exchange rate market is now highly sensitive to the Middle East situation, the Korea-US interest rate gap, and capital flow changes. The rise in oil prices is also being pointed out as an important cause of the sharp increase in the exchange rate. Currently, the ceasefire negotiations between the US and Iran are at a standstill without any clear progress. Additionally, the armed conflict between Israel and Lebanon is increasing instability in the Middle East. The market expects prolonged negotiations, raising concerns about oil supply disruptions. International oil prices are rising rapidly. West Texas Intermediate, WTI, crude oil has surpassed $96 per barrel, and Brent crude has also risen to around $97. Before the Middle East war, oil prices were around $60, but now they're nearly $100. High oil prices continue, and this is quite a burden for Korea because most of its crude oil is imported. When oil prices rise, more dollars are needed to purchase crude oil. As companies start buying dollars to pay for oil imports, the demand for dollars increases in the foreign exchange market, which puts upward pressure on the $1 exchange rate. Market sentiment is also having an impact. When war or military conflict escalates, investors tend to prefer safe assets over risky ones. In this process, demand for the dollar, which is considered a representative safe asset, increases. The more investors seek dollars, the higher the value of the dollar rises, and the value of the won weakens in comparison. This is why the foreign exchange market is currently reacting sensitively to the situation in the Middle East. If negotiations between the United States and Iran resume and tensions in the Middle East ease, oil prices could also stabilize. On the other hand, if military conflict escalates or tensions rise around the Strait of Hormuz, oil prices could rise further, and it's hard to rule out the possibility that the exchange rate could climb even higher. That's why the foreign exchange market is now closely monitoring not only Korea's economic indicators, but also developments in the Middle East and international oil price movements in real time. The government has said it will take market stabilization measures such as verbal intervention, but since there hasn't been any real action, these measures don't seem to be having much effect. Deputy Prime Minister and Minister of Economy and Finance Koo Yoon-chol verbally intervened at a market situation review meeting, saying that necessary measures would be taken immediately in response to excessive volatility. Shin Young-song, the governor of the Bank of Korea, also issued a warning, stating that he would respond firmly to excessive movements in the exchange rate. However, as you can see, the upward trend in the exchange rate is not slowing down and continues to grow. But if you ask whether the Bank of Korea can aggressively raise the policy rate to control the exchange rate, it's not that simple. This is because one of the biggest burdens facing the Korean economy right now is the household debt problem. The scale of household debt in Korea is already among the highest in the world. There are a lot of households with various loans, such as mortgage loans, credit loans, and John's loans, and many households are very sensitive to changes in interest rates. If the Bank of Korea raises interest rates to defend the exchange rate, the first thing that will happen is that the burden on borrowers will increase. Especially in Korea, the proportion of variable rate loans is high. Unlike countries where fixed-rate loans are more common, when the base interest rate rises, it is quickly reflected in actual loan interest rates. This means the shock felt by households can be even greater. Households with large loan amounts will see their monthly interest payments increase, and their ability to spend will decrease. The problem doesn't end there. When consumption falls, it hurts sales for self-employed and small business owners. Companies facing higher funding costs may cut investments or slow hiring. If interest rates rise during an economic slowdown, the economy's burden increases further. This chain reaction is why financial authorities must be cautious with rate hikes. Korea's household debt to GDP ratio is now about 89.5 high by international standards. It ranks among the top OECD countries, after Switzerland, Australia, Canada, the Netherlands, and New Zealand. Looking at the countries with higher ratios, Switzerland is at 125.3%, Australia at 112.7%, Canada at 99.1%, the Netherlands at 94%, and New Zealand at 90.1%. This means that the Korean economy is highly sensitive to changes in interest rates. A high household debt to GDP ratio means that if interest rates rise, the amount of interest people have to pay can also increase rapidly. In fact, concerns about rising delinquency rates and an increase in bad loans have been consistently raised in the high interest rate environment of the past few years. While the entire financial system is not yet in crisis, there are ongoing warnings that if interest rates remain higher than expected for a long time, the burden could grow, especially for vulnerable borrowers. In particular, since the amount of loans connected to the real estate market is large, financial market participants are also reacting very sensitively to changes in interest rate policy. For these reasons, the Bank of Korea is faced with a difficult choice between stabilizing the exchange rate and supporting the economy. If it raises interest rates to stabilize the exchange rate, the burden on households and companies could increase. On the other hand, if it keeps interest rates steady to support the economy, the interest rate gap with the US could persist, putting continued upward pressure on the exchange rate. This is exactly what the market is concerned about right now. Since the exchange rate issue and the household debt issue are interconnected, it is difficult to quickly improve the situation by solving only one side. Therefore, the current high exchange rate phenomenon is being interpreted as a result that reflects not only external factors, but also the structural challenges facing the Korean economy.